We're looking at another perplexing dynamic in global financial markets where it's difficult to reconcile what could easily be described as confounding price action. Global growth concerns have manifest in the bond and FX markets, while at the same time stocks are seemingly unbothered. On Wednesday, we saw another major central bank step up and surprise with a more dovish-leaning policy decision that echoed the sentiment of the Federal Reserve, with the Reserve Bank of New Zealand communicating an expectation that the next adjustment to interest rates would be lower. This triggered an intense liquidation of Kiwi longs, with the US dollar benefiting as a result. While yield differentials played their part, there was also a clear participation of flight to safety on these concerns of the downturn in the global growth outlook. This was further highlighted by the way the Swiss franc reacted, with this other traditional safe haven reluctantly absorbing the risk liquidation in FX, triggering a drop in the Euro-Swiss exchange rate below the 112 handle and to its lowest level since July of 2017. And yet, despite all of this, U.S. equities have held up, refusing to bow to this pressure and presumably welcoming it as investors continue to cling on to an exhausted strategy put in play a decade ago, incentivizing investment in stocks in a world of unprecedented monetary policy and fiscal stimulus. Safe haven FX activity, inverted yield curves, it hasn't mattered. Stocks still sit just off those record highs from late 2018. We've yet to see investors spooked for any meaningful period of time, and we wonder what, if any, catalyst will finally tip the scale. If there's one currency that's impressed amongst all of this, it may be surprising to know that it's been the pound. We've highlighted the possibility that the pound could indeed be in position to outperform in 2019 with the elimination of a major tail risk to a major currency, exactly the type of thing to account for this. Brexit uncertainty remains, but it's become increasingly apparent that it won't be the walking off the edge of a cliff risk that has been overly priced into the pound from mid-2018 into January of this year. As far as the euro goes, we continue to see the single currency supported into dips, and comments from the ECB president should add further support after Draghi today said a soft patch did not necessarily foreshadow a serious slump. Overall, it will be interesting to see how this macro dynamic plays out, and things like US-China trade updates and SNB reaction to Swiss franc demand should be monitored. Looking to Thursday's calendar, highlights include Eurozone confidence readings and US growth data. That's all for now.